Evening, everybody. Thank you all for filling this room firstly. So I think you made a good decision today. You came to the lectures and you decided to listen to me at the end of the day. So I really appreciate that. I usually start these talks by just giving a piece of advice that I had that I would give to myself if I was in your seats back when I was in university. I went to Durham University in the UK, and I was the president of my university finance society. And we had a lot of different speakers come and talk to us on lots of different topics and subjects. It wasn't just investing, it was about business more generally, or course specific. And the piece of advice I would have given myself back then was to attend as many of these things as possible, because I think it's a good way of exposing yourself to different ways of thinking, different mental models. And I think if you have a curiosity and a passion to learn in general, I think that is the long-term key to success. I think all of you in this room clearly have that, otherwise you wouldn't be here this evening. So congratulations on being here at Trinity. It's an incredible university. And I would just say, this is part of your journey and absolutely make the most of it. So with that, my talk to you this evening is going to be on how not to build a $1 trillion business. So the reason why it's called How Not will become apparent hopefully during the course of the lecture. So what we're going to be using this evening is the mental model of inversion. So the two gentlemen you can see on the left-hand side here are Mr. Warren Buffett with the blue tie. Please come in. And his business partner, Charlie Munger, the late Charlie Munger with the red tie. And essentially, the concept of inversion is the Stoic philosophy that was explored in the writings of the Roman Emperor Marcus Aurelius between 120 and 180 AD. He was actually a battlefield general. So what he thought about was, rather than how to win on the battlefield, why not think about how to lose? Because if you thought about what you had to do to lose, if you did the opposite of that, then clearly you would win. And that was the concept of inversion. And essentially what Charlie Munger did was try to take a modern day twist on that. He tried to bring 120 AD to the present. And he wrote a book, which if any of you really want to read something quite miserable, it's actually called How to Guarantee a Life of Misery. Because it takes this concept of inversion and it's trying to talk about what not to do to lead a successful life. The idea being you should do the opposite. And he says here, invert, always invert. Turn a situation or problem upside down. Look at it backwards. What happens if all our plans go wrong? Instead of looking for success, make a list of how to fail. Instead, through sloth, envy, resentment, self-pity, entitlement, all the mental habits of self-defeat. Because if we avoid these, then we're guaranteed to be successful. So I'm Ardal Loh-Gronager, and I'm the managing partner of a hedge fund based in London called Loh-Gronager Partners. My background is I'm half Danish, but I went to university in the UK. As I said, I went to Durham. I studied accounting and finance at university. I would always say I was an entrepreneur first and an investor second. I always had a love for business. And during my period at university, I did several internships, which I'm sure all of you are aware of and have done yourselves. So I did sales and trading at Goldman Sachs and then Swiss Re Asset Management, so the buy side and sell side. I then got a full-time job as an interest rates trader at Morgan Stanley, so very much the macroeconomic side of the business, analyzing global capital trends, macroeconomic flows, please come in, and their impact on interest rates. And then from there, I moved to the microeconomic side of the business. I moved to be a credit trader at Credit Suisse. And this was appealing to me because I think if you want to understand the full investment landscape, you need to understand the macro and the micro. And micro here was the concept was I was trading the capital structure of banks. So banks are very complex institutions. They have lots and lots of different bonds that they issue, convertibles, AT1s, contingent convertibles. And I was essentially trading those and working out where within the capital structure we should be investing our own money as the bank, but also recommending to our clients to invest either alongside us. And it was during this period of time that I came up with the investment strategy that we run at our fund today. In addition to that, I am the author of a book called The Perceptive Investor that was published last year. So it was published alongside in conjunction with the Financial Times newspaper. So all of the proceeds from this book are actually donated to the Financial Times charity on literacy and inclusion. Because I really do believe that all of us participating in modern society today, we need to have an adequate knowledge of finance. Otherwise, it's very hard to participate. It's important to understand that the APR on a credit card, the higher it is, the worse it is, which some people don't quite grasp until a little bit later on in life when it's potentially too late. So I'll be donating a signed copy of this to whoever asks me the best question during the Q&A. And if there are any value investors here, if there's only one question, then you get the book. So that should work out well. So the book itself, it's called The Art, Science and Temperament of Successful Value Investing. And this is one of the subjects that we're going to come on to during the talk, which is where I think that one of the key things that separates out the very best investors from the rest is that final concept, it's temperament. And that's something that we're going to touch on. In terms of my fund, Loh-Gronager Partners, we're based on the principles of the original Buffett partnerships established by Warren Buffett in the 1950s. So one of the things that's not that well known about Warren Buffett is before he took over Berkshire Hathaway, he actually for 13 years ran his own hedge fund called the Buffett Partnerships. And they had some of the best returns of any hedge funds in history. So he was obviously a very talented investor even then. And what do? Well, we're concentrated long-term value investors. So we're looking to buy substantial stakes in publicly listed businesses, working with the management teams and owning them for the long term. When people ask me, how do you describe your investment philosophy? I actually sometimes think a picture is worth 1,000 words. So here what you can see on the right-hand side of the screen is a picture of a painting. It's by the Belgian artist René Magritte. And it's called La Clairvoyance, but it translates from French roughly to perception, which is coincidentally, or not coincidentally, the title of the book. And the reason for that is, I think what you can see here is really what investing is all about. You have the artist, pictured seated. He's looking at a stationary egg. And yet on the easel, on the canvas on front of him, he's painting a fully grown bird in flight. That's what perception is. Our job as investors is to take a view of all the publicly available information, the egg, and project forward a different conclusion from that of the market that's priced in, the bird on the canvas. And that's essentially what our job is. In terms of the hedge fund industry more generally, for those of you that aren't fully familiar, the original hedge fund was started by a guy called Alfred Winslow Jones. And the reason why it was called a hedge fund was because he went long a basket of stocks and short a basket of stocks. So he thought some would go up, some would go down. And that's where the term hedged or hedge fund comes from. But even from back then in 1949 and then from Buffett in the 1960s, the model of a hedge fund has always remained the same. You have a pool of investors that entrust their capital to a hedge fund manager, such as myself. We invest that capital into a portfolio to achieve, hopefully, a specified rate of return that's adequate for those investors for the risks that we're taking. And then in terms of the hedge fund industry more generally, just so you've got an idea, there are roughly 10,000 hedge funds in the world. They manage about $4 trillion of assets today. And you can see here that there's an absolute plethora of investment strategies, everything from sector-specific to option strategies, to equity long only, which is what we do, to fixed income and event-driven arbitrage, etc. So there's a lot of choice. But interesting statistic here is on the bottom left is the average lifespan for a hedge fund is only 4 years. And I think that's an interesting one. We can pick that up, why that might be in the Q&A. So on to tonight's subject then, how not to build a $1 trillion business. So in investing, we're told that there are only 3 variables that ultimately affect the returns that any of us is going to make. The first is the starting capital. How much money do you have to start with when you invest? The second is the rate of return that we can make on that capital. And then the third and final one, they say, is the length of the runway, i.e. how long are we going to be able to invest that money for at that rate of return to ultimately end up with what we have at the end. However, I would add a fourth to this. And the fourth one I actually think is the most important. It's temperament. I.e., you have to have the conviction to invest, i.e. rule number 1, the starting capital in the beginning. That's having the right temperament. You have to have the skill to be able to select the investment to achieve that given rate of compounding. So that's the second rule there. And the third, the right temperament, allows you to have the patience to allow the thesis behind your investments to be carried out. So that would be the length of the runway. So I would posit that you can't achieve 1, 2, or 3 without having 4. So my friend Bill Miller, you can see the quote at the top of the slide here. He essentially said that broadly speaking in investing, there are only 3 advantages that anyone can have. So the first is informational, that I know something you don't about this business or about this investment. Now, today, that's probably quite unlikely, and in general, probably be illegal, because what we're talking about there is inside information. So that's not really going to work today. The second is the second is analytical, that I'm able to use all of the publicly available information to arrive at a superior conclusion to everybody else, i.e. I'm smarter than everybody else. Again, one would have thought incredibly difficult given the brain power of people competing in financial markets in general. And the third, he says here, is psychological or behavioral. And it's the third, he says, that distinguishes the exceptional investors from the rest. And from my own experience, I also believe that that is the case, that it's the psychological or behavioral traits that ultimately lead to the success or failure of an investment. And it's the powerful mental model of inversion, or how not to do something, that I think is key here to success, modeling it differently. So we're going to walk through today an investment case study of a company whose products all of you will likely have used, and yet probably has never appeared in any of your investment portfolios. So I'm going to give you a couple of clues and just see if anyone can pick them up. They're slightly obscure clues, so I'm not expecting you to know the company we're going to discuss. So the first is that this company is over 100 years old. So it's been around a long time. The second there is that everyone will likely have used its products or at least heard of this company's name. The third, it's unlikely that I think that any of you have ever actually invested in a stock. And the fourth, the most telling, is that it's actually headquartered in the Netherlands. So this is a company that all of you have heard of, that I think could have been $1 trillion business for many reasons that we'll go through, but it's not. I would argue, and I'm going to discuss during this lecture, that I think that the key reason why this business didn't make $1 trillion or isn't worth $1 trillion in market cap today is because it failed those 3 rules because it didn't have the right temperament. The management team didn't have the right temperament. So I'm actually talking about the Dutch company, Philips. So Philips, or Royal Dutch Philips, it was founded in Eindhoven in 1891 by Gerard Philips and his father, Frederick. Their first product was actually a light bulb. And as we're going to see, in the 20th century, Philips grew into one of the world's largest electronics conglomerates. And yet today, it's a healthcare-focused company with a market capitalization of $25 billion. So it's a reasonably sized business for developed markets, but it's clearly not worth anywhere near $1 trillion. And therefore, I think the market cap today only tells a small part of the story that we're going to explore today. So what mistakes did Philips make that stopped it from becoming $1 trillion business? And tonight we're going to discuss 3. So the first mistake is ASML. And I would say that this cost Philips $350 billion. In 1984, Philips' management team was under pressure from Japanese competition for CD and cassette players, later DVD and Blu-ray players, all of which Philips had actually invented. And I didn't know this until I started doing the research on Philips. They invented the CD player and the DVD player and the Blu-ray player. And this shows that they had an incredibly talented R&D department. You know, people came from around the world to work for Philips' R&D department. They really were a bastion of amazing products and innovation. The issue was the Japanese competition was slowly but surely hitting Philips on the income statement. And at this time in 1984, they were actually having negative net income. And what happened is management panicked, in my view. What management decided was that if they got rid of a significant portion of their R&D budget, the company would automatically be profitable. So what they decided to do was to split off the activities immediately of one of the most promising products that they had invented. It's quite a mouthful, but it's called the field of photolithographic integrated circuit production equipment. All of us will today know this as the semiconductor business. That's essentially what they invented. And that's what these machines are here. These are actually the very early semiconductor production equipment machines that Philips had essentially created. And what they decided to do was spin out this part of their R&D department into a new company, into a joint venture with another Dutch company called ASM Limited. And what they would do is they'd locate this company in the Netherlands and they'd call it ASML. So ASML, as I'm sure all of you know, or should know, it's the most valuable company in all of Europe today. They make all of the semiconductor equipment that makes every chip pretty much in the whole world. So one of the world's most valuable companies and Europe's most valuable business. It went public in 1995. And by that time, Philips actually owned 100% of the business because their JV partner ASM had actually gone bankrupt and Philips had bought the shares. Philips sold 75% of their stake in the business at the IPO for $350 million. And they disposed of the rest of the stake over the course of a few years. And that single investment today would be worth $350 billion. So that's why I call this the first mistake that cost Philips $350 billion. So ASML today is Europe's most valuable business. It's also the world leading semiconductor equipment manufacturer. And it's exactly this. The issue here is while Philips disposed of 75% of the business for $350 million, the remaining 25% they disposed of very quickly because the net income of the business didn't go up as rapidly as management were hoping. And therefore they kept selling the shares into the market as the price went up, rather than holding onto that stake. And even a 25% stake of a 350 or to 500 billion worth business today is a significant value. The second mistake is even bigger. The second mistake I call the TSMC mistake, and this cost Philips $500 billion. So why did this happen? Well, I think the second mistake Philips management team made was to use their successes to fund their failures. And as an investor, we see this often, where investors sell their winners to buy more of their losers. Daniel Kahneman, Enos Tversky have done a lot of work on this, about the fact that it's behavioral psychology, that we as human beings tend to hold on to losers and sell winners too quickly. And this is essentially what I believe the management team here did with TSMC. So there's a bit of history. In 1985, Philips, along with Morris Chang and the Taiwanese government, through its National Development Fund, established TSMC. The reason why Philips was invited in was because they were an absolute pioneer in this technology. Philips originally had a 51% stake, and that was diluted down over time. They had about a roughly 33% stake at the time of the IPO, and they sold down the stake and they fully exited the investment in 2008. Today, TSMC is the world's leading semiconductor manufacturer. The market capitalization of the business is $1.5 trillion. So this, if we just take the 1/3 stake that Philips owned at the time of the IPO, has cost Philips $500 billion by not holding on to this business. So when I think a little bit more about why did the management team do this, I think there's a few issues here. So from the time of the IPO in 1994, Philips was a consistent seller of the stock. And there's two reasons for this, which I as an investor think are major red flags that I look for in any investment that we're looking at and reviewing. So the first is earnings smoothing. And this for me is a big red flag. This is where the management team is more concerned with the reliability and stability of their results over time than they are about the business itself. Anyone that runs a business knows that it's messy. If you ask the CEO of a business, what are you going to make next month? They're going to give you their best estimate. Wall Street are fixated on what you make every quarter, what you make every 6 months, and what you make every year. Shareholders tend to be very interested in what dividends they're going to receive, and they want to see it consistently increase over time, hopefully. And what I think here is Philips' management team took their eye off the ball, and they were way too focused on delivering that consistency. That consistency tends to be rewarded in the market with a stable to rising share price. You get less volatility in the shares. Whereas actually, if you look at most management teams, they are less concerned about the short-term market moves of the stock, more concerned about the business. So that for me is the first red flag of Philips' management team. They were pandering to Wall Street, which to me is a big red flag because you're taking your eye off the ball as regards the business. And the second is related. The second was that the original ownership-minded management team had essentially been replaced over time by professional bureaucrats that believed that rather than hold on to something of value that was making them money, that they knew that they were world-class and world leaders at, such as semiconductor equipment manufacturing, they actually decided that they were better off diversifying the business away from that to things that they didn't know much about. So they were selling their winners to invest in unknown technologies, which one might argue most ended up to be losers. And they were, another thing that concerns me, those ideas were usually outside of their circle of competence. So their circle of competence was clearly semiconductor manufacturing. You see that from example number 1, example number 2, and we're going to see it from example number 3. We know what Philips was good at, but the management team seemed to be convinced that actually rather than focus on being good at that, they should diversify the business away. And this is the final issue, is trying to think of investing in things only within your circle of competence. And I often get asked, what's within my investment circle of competence? To ask the question is to answer it. If you don't think it's within your circle of competence, it probably isn't. You should only be investing in things you really, truly understand. The third mistake that Philips made was the worst in my view. And that was that they didn't learn from the previous two mistakes. As an investor, I'm entirely focused on evolving my investment process over time, as that's something that I can control. Every time we have a successful investment, every time we lose money on an investment, there's something to learn. And we can integrate those learnings into our investment process that we're trying to evolve over time. We're less focused on the investment outcome in the short term. There's nothing I can do. If I buy the stock today, I don't know whether it's going to go up or down tomorrow. There's not really something I should be very concerned with. I'm concerned with what's the business going to do over the next 3 to 5 years. I've got a long investment time horizon, and that's what sets us apart. And I think that most successful investors spend the majority of their time focused on exactly that, focusing on their investment process and making it better over time than focusing on the immediate outcome. And that was something that Philips' management team was very much focused on. So the final mistake we're going to go through is the NXP mistake. And this, comparative to the other two, was slightly less expensive. It only cost the Philips management team $50 billion. So in 1998, Philips knew that semiconductors were going to be the future. I mean, it's pretty much all any of us read about in the newspapers today. And Philips knew about this 25 years ago. In fact, they'd established an emerging business group for it in Silicon Valley in the US. And the group was designed to be an incubator where promising technologies and products could be developed. And this comes back to the first mistake. Philips had an amazing R&D department. People aspired to work for them. They had the most innovative and cutting-edge technologies. But it's very expensive to have a good R&D department. So it's the easiest thing to cut and therefore increase your profitability. By 2001, this group had $1 billion of revenue, was growing exponentially year on year. This is an example of a wholly owned internal subsidiary of Philips, that they knew the business incredibly well. They knew the future was going to be bright for this business. And despite that, they decided to sell it to a consortium of private equity buyers led by KKR and Silver Lake. And those private equity companies held onto the business for about 5 years. The growth rate continued to be rapid. They IPO'd the business, and today it's worth $50 billion. And it's one of the biggest semiconductor businesses listed in Europe. So what can we glean then from these examples to answer the question of how not to build a $1 trillion business? Now, the first thing I put on this slide is a disclaimer, because I know that some of you here will be much better than me at maths. And that is that the current 25 billion market cap of Philips, plus the 350 billion mistake with ASML, 500 billion with TSMC, and 50 billion with NXP doesn't quite add up to $1 trillion yet. But there are several other mistakes that I haven't gone through in the presentation, including the fact that they used to own the battery division of Panasonic. So anyone that has an electric battery, there are several suppliers of these. So you've got CATL in China, you've got BYD in China, and actually the third biggest provider is Panasonic. So it provides some diversification. It's an incredibly valuable business. So I think that actually these examples, just between them in the next few years, as the market caps of TSMC and ASML, perhaps NXP also increase, will show that Philips has lost $1 trillion compared to what it could have had. Could have been one of the 5 most valuable businesses in the world today. So what lessons can we draw from this? I think there are 2 lessons. The first is simplicity. And I think, as with all things in investing, the simpler we can make the answer, likely the better we understand the answer. And I think that's one of the core components here. What was Philips' management team's job? Their job was to excel in the areas within which they had specialization. And they took their eye off the ball on that. And the second is temperament. So this is coming back to the 4th variable I said that is so important, that dictate any return you're going to make from an investment. So the first 3 were your starting capital, your compounding rate, and your investment time horizon. And I said that it's my 4th variable, temperament, that's ultimately going to dictate the returns that we receive from any investment. Philips' management team were good business people, but they were not good investors. And exceptional capital allocation skills are what sets apart the management teams of $1 trillion businesses and those that will never make it. And with that, I would just like to say thank you very much for your time today. And I'm very happy to answer any questions you might have.
Sure. So obviously a hedge fund is supposed to generate uncorrelated returns via alpha. Do you think that that's an actual alpha is possible with value investing?
Yeah, it's a good question. So I think if we go back to the original slide where I showed you all the different hedge fund strategies, I think there are lots of different models of hedge funds. I would say that our way of delivering alpha is very different. So ours is by having a long-term investment time horizon. The majority of our competitors are focused on what are the returns in the stock market today, next week, next month. We're very much focused on 3 to 5 years out. So we can take a much longer term view. As opposed to a lot of our competitors who see volatility as risk, we see volatility as opportunity because we don't use any leverage. So when the stock falls 50%, if I know the business, I might think it's on a 50% discount. I want to buy more of it. So that's by being a contrarian value investor. So I do believe that there is a lot of value, a lot of alpha generated by value investors over time. I think the other part of our strategy is, as a hedge fund, as you point out, is the fact that rather than going short stocks, so a typical hedged equity fund, equity long short would buy and sell, we go long fixed income. So we have a portion of our portfolio, we can have up to 50% of our fund can be invested essentially in US treasuries. And typically speaking, during a period of market volatility, the only thing that seems to go up in price are front-end US treasuries in a flight to safety scenario. So typically speaking, if we can't find great investment opportunities, if we think that the market is going to be due a significant drawdown, we can put more of our portfolio in US treasuries. And a good example of that would have been most recent Trump tariffs from last April. So we had roughly, at the time, 7% of our portfolio in front-end US treasuries. We obviously didn't know what Trump was going to announce. Trump announces the tariffs, global equity markets fall between 10 and 20%, depending on the market. Front-end US treasuries go up by almost 10% in a day. So that's a good example where we can sell on a high and then buy on a low. And that's adding alpha over time. Thank you for the question. I'll take one in the back.
Yeah, thank you for that. I had a question regarding the Phillips. So, I suppose you could argue that Phillips kind of took the what they thought was the safe option. Take cash in now, and selling their stakes and diversify, try and save up future revenue. And then you also talked about temperament. Would you say that that's a kind of a European temperament? And if that is, obviously Europe is dwindling now and it's kind of power in the world. So would you say that it's a European temperament that we need to change if we want to stop things like that happening?
So would you be saying that you think that sort of that risk-averse temperament is more European? Is that what you're saying?
Yeah, exactly.
I think I don't want to culturally stereotype, but they say the US innovates, China imitates, and Europe regulates. That's what we say in markets. I think there are examples in all markets of companies that act in a non-stereotypical way. One of my favorite examples is Naspers out of South Africa. They invested $25 million. I'm going to get the year wrong, but let's say it's close to the year 2000, in Tencent, when Tencent was just being founded in China. It was 5% of the market cap of Naspers. And they held that investment for the next 25 years. And that investment today is worth $120 billion. They've never sold a share, other than when it was required for regulatory reasons. So I think it is possible to run a business, to hold on to compounders for a long period of time. And I think this comes back to one of the salient points about value investing, which is we are trying to own these businesses for the long term. And there's a reason for that, because the magic of compounding only comes at the end of the holding period. So if you've got a business, it's one of my favorite examples. So if you've got a 10 stock portfolio, so you put 10% of your portfolio into 10 different stocks. If 9 of those stocks go to zero and one of them goes up 100 times, anyone want to hazard a guess of what your return would be over 10 years on an annualized basis? There's got to be some mathematicians in here that can do quick maths. Okay, so it's just under 20%. So you can invest in 10 stocks, 9 of them go to zero, one goes up 100x, and you'll have annualized over 10 years just under 20%. That's the power of concentrated returns. But the compounding comes at the end of the period. So if you own a business that is compounding capital at 20% per year, how many years do you think you'd have to hold it for before you made 100 times your money? It's the same question, but in reverse, basically. So it's roughly 25 years. So if you bought Amazon in the year 2000, and its compounded capital actually just above, it's actually compounded capital at 25%. So you'd have to own that business for 20 years to have made 100 times your money. So even an unbelievable business like Amazon, you have to own it for 20 years to make 100 times your money. If you only owned Amazon for 18 years, you'd only make 50 times your money, because that final holding period doubles all of your returns. And that's the power of compounding. The real power comes at the end. And there's the statistic that is widely flouted about Warren Buffett. 99% of his net worth came after his 65th birthday, which is an amazing thing to think about. So he's 95 today. He was worth $1 billion when he turned 65. He's given away 120 billion so far in his lifetime, and he's still worth over 100 billion today. So he made $249 billion between 65 and 95, because all the power of compounding comes at the end. So that's where I think, in answer to your question, the holding period, the length of the runway, compounding, that's where the real magic happens. And I do think that even in a corporate structure, like what we saw here, it is possible for management teams to do that. I do think Philips, you could argue, might have taken the safe option, but I'd actually flip it on its head and I'd say, I think they did the really risky thing. They had cash cows, businesses, and they decided to sell those, take the money and invest it in businesses that weren't making any money. I personally see that as extremely risky. I would have kept on to the winning businesses and allowed them to continue to compound over time. Thank you for the question. Sure, at the back.
Yeah, I read that your investment decision process runs through your 250 question checklist. So if you could only use one, what one would it be?
So, I've helpfully got a slide on this. So this is our investment process. I think a picture, again, is worth 1,000 words. We have an inverted funnel investment process. And the reason why it's an inverted funnel is because we're bottoms-up stock pickers. We are kind of macro agnostic. We're looking at individual businesses, so the widest part of our funnel will be at the bottom. There's roughly 45,000 listed equities globally that you could invest in. And essentially, that's your investable universe. And we have 3 stages to it. The first is you've got to source your investment ideas. The second is you've got to evaluate them. And here, we're trying to evaluate through our circle of competence, quantitative analysis and qualitative analysis, what we think are exceptional businesses. So that's the middle step. And the final step is therefore the investment decision, buy, sell, hold. So to answer your question, if I could only pick one thing out of our checklist of roughly 250 questions, it would be the capital allocation skills of the management team. I really do believe that that is the single differentiator, even when we come back to the example today that I gave you, that we're looking at with Philips. It comes down to the capital allocation skills of the management team. What is the reason why Berkshire Hathaway has been one of the best performing stocks on the stock market in history? It's the capital allocation skills of Warren Buffett. What's the reason why Philips has achieved a terrible return for its investors, arguably, since its founding in '84? The reason there is the poor capital allocation skills of the management team. What's my job as an investor is to have good capital allocation skills, to find exceptional businesses that are publicly listed around the world that I invest mine and my investors' capital in, and we're compounding at a high rate. So my job is capital allocation. So I think if I could only ask one question or investigate one thing about a management team, it's how good are their capital allocation skills? And the way that I do that is I would look at all of their annual letters and I would see what did they say they were going to do. And then I'd look at the next year's annual letter and financial statements and I'd see what they actually did. Because I think one of the key things is listening to what people say is always quite interesting. Seeing what they do can often be far more revealing. So what I want to see is I want to see a management team that come up with great capital allocation ideas, new investments, new areas of reinvesting capital at high rates of return. I want to see them find these ideas, execute on them, and earn the returns. And those are what we call footprints in the snow. And that's what gives us the confidence to entrust the management team today with our capital, because we have a history of them doing a good job in the past. Thank you for the question. Sure.
So I suppose like as a long only fund, we had a focus on value investing. So my question is like, how do you navigate times when I suppose the market's in more kind of a momentum driven state and kind of valuations become stretched and companies don't necessarily trade in line with like what I presume like the fundamental analysis you've done is. How do you kind of navigate those periods and like how do you kind of stay anchored to that kind of value investing thesis when there's like retail traders like propping up prices, or do you just kind of believe that in the long run of your kind of investment horizon that like I suppose the price will eventually kind of reach that target that you believe it's kind of worth?
It's an interesting question, and I think there's lots of different ways of answering it. But I'd say in our specific case, we have a 30 stock portfolio, roughly speaking. We own 15 businesses in developed markets and 15 businesses in emerging markets. And what I'm going to do is I'll use inversion on this question. I'm basically going to say that we don't do what you're suggesting there. So we don't care about momentum because we would never go to a momentum-driven market. So for example, for me, we have 10% of our fund invested in Turkey. Why do we have that? Because 3 years ago, there were a bunch of headlines in Bloomberg and the Financial Times that said Turkey's uninvestable. President Erdogan is a madman. He believes that to reduce inflation, you need to reduce interest rates, which goes totally against Economics 101. But that, therefore, is very interesting to me. I then looked at the Turkish market, and you see that all the big investors are exiting Turkey. Valuations, loads of the businesses there are trading below liquidation value. So that, therefore, is very interesting for me as a contrarian investor. I typically want to go to markets where the momentum is going against me, where everybody's selling. Because I normally think that those are markets where people lose sight of really what's very important in markets. It's another reason why we have roughly 10% of our fund in China, because it was 2 years ago where a lot of the financial press was basically saying China is uninvestable. So at that point, I jumped on a plane. I spent 6 weeks traveling around China, trying to find exceptional investment ideas for us. Because typically speaking, most people just follow the media. If the media says something is uninvestable, you tend to see a lot of capital outflows from that country or that economy. You tend to see a falling stock market. And that, for me, as a long-term value investor, is very attractive. A market where, for example, if we're talking about the Mag 7 in the US, which seems to be on the surface of it very momentum-driven, we've seen over the last, there's a good graph, which I don't actually have in this presentation, which shows the amount of money invested in passive funds has been increasing year over year. And the amount in active funds, such as mine, has been declining year over year. And they actually crossed over 2 years ago, where now more money is run by passive funds than active funds. And passive funds is a bit of a misnomer, because if you invest in, for example, an S&P 500 tracker, it's not passive, it's active, because you're actively choosing to allocate more money to the highest market capitalization weighted businesses in the US. That's an active decision. Every time you put $100 in there, it's putting more money into NVIDIA than it's putting into number 500 in the S&P 500. So you're basically investing in a momentum-driven investment strategy. Now, that's not to say that we would never own any of the Mag 7, but their valuations would probably make them unattractive to me as a value investor. It's not that they're not exceptional businesses, but their scope for price increases, their scope for market share. For me, it often comes back to when we're talking about the learnings that I said from presentation, I said one is simplicity. A really simple law in finance is the law of large numbers. Trees don't grow to the sky is another way to say it. How tall does the tallest tree get? How big can the biggest company get? Now, it's true, over time, companies have tended to get larger because they now operate in a global market versus a single country. But how big a company or how big a business can NVIDIA become? If you buy NVIDIA today at a roughly $5 trillion market cap, and you want to make 10 times your money, you're betting that NVIDIA is going to become a $50 trillion company, right? It's going to be half the GDP of the US. That is a massive, massive business. Now, it's not impossible, but it's probably unlikely. And therefore, in the law of large numbers, you'd be looking at smaller businesses with smaller market caps if you want to have high returns. And that's where all the academic research shows you. Small caps tend to make better returns than mid caps, tend to make better returns than large caps over extended time horizons, because it tends to be there's more volatility in those prices and they also have more scope to increase. And that's just the law of large numbers. Thank you for the question. Sure, at the back, and then.
Just have a question on temperament.
Sure.
And just if you consider it to be a spectrum, a skill, or something that's binary, in terms of like, can you get better at it? Is it something you have or don't? Or is it something that on a scale?
Yeah, that's a really good question. And it's actually one that I've wondered a lot. I think that the best investors have a natural temperament. I think they do. But I do think it comes from your life experience. So therefore, I do think to a degree it can be trained or improved. And I think that all of the great investors that you study are all constantly working on evolving their investment process over time. I think they're less fixated on what was my return today, what was my return this year. They're more focused on what's my 5-year return going to be, even if they have a short-term investment strategy. Because the temperament that's required to be able to continuously battle in markets for year after year to achieve those returns requires a longer term investment time horizon process. And it also requires equanimity. If you're someone that gets very upset when you lose money, when you see a red number on a screen, this might be a really hard business for you because it happens all the time. They say that in what I do, the best investors are right 51% of the time. If you're day trading, it's probably even less, because what matters is it's not how often you're right, it's how much money you make when you're right versus how much you lose when you're wrong. So actually, some of the quantitative investment strategies lose money an enormous amount of the time, way more than 50%. But the amount of money they make when they're right on the asymmetric upside bets is far more than they lose when they're wrong. But it takes a very particular personality type to be comfortable with that. Seeing constant red, 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 big green. Different personality type. So I do think that your experiences can lend you one way or another, but I do think that the best investors do have a tendency towards that temperament. It's not necessarily inaction. I describe it more as equanimity. It's, for example, in answer to your question from before, we see volatility as opportunity. When I see the Turkish stock market down 30%, I don't panic. I go, great, let's go and have a look at some more businesses there. Let's see if our businesses are still just as good. Should we be allocating more capital to them? And that temperament is quite different to be a natural contrarian. I do think you can develop that over time to a degree, but it still comes back to the original point. I think you have to invest in a way that's confluent with your own personal characteristics. Some people will be more attuned to fast, high-frequency trading. Some people will be more attuned to longer-term investing. Some people are more attuned to having an index fund. Some people are more attuned to a 60-40 bond equity portfolio. And one of the things I'd say that's really important is to try as many things as you possibly can. Don't risk too much money in any single thing and figure out what you're good at, but figure out what fits with your personality type. Investing is like the most personal of journeys. How I invest is not at all how I think you should invest. I think everybody has their own unique investment style. And the key to being a successful long-term investor is figuring out what that is. When I was in university, I tried everything. I did options trading, foreign exchange. I bought CFDs on oil contracts. I thought I'd be a global macro trader. I tried lots of things. But I figured out what works best for me was analyzing individual businesses and holding a portfolio of them for the long term. It's how I made my best returns. And it also suits my personality type. And that's one of the things I think all of us should be trying to find when it comes to being a successful investor.
So the thing you mentioned about kind of the contrarian is a sentiment that I agree with, but it's also easier said than done. So like you probably need the agency first of all to be able to make contrarian bets and stick to them long enough for them to turn out. And then you also need people in your fund working for you who have that same kind of like behavioral edge that you mentioned that you kind of have. So how have you gone about setting out a fund structure in that way so that it allows you to have that agency? I read that you don't take a management fee and invite, and I'd like to kind of hear about that. And then also how you found other people who have that same sort of behavioral edge.
Sure. So, our fund is a little bit different. So most hedge funds charge a 2% management fee and a 20% performance fee. And we don't charge a management fee. And we took that idea from Warren Buffett. He originally, when he started his Buffett partnerships, he said, why should I get paid if I don't make you any money? So I'm only going to charge a performance fee because I only make money if you make money. It's quite straightforward. It's actually a really easy selling point. The reason why funds charge 2 and 20 is because the manager gets rich off the 2%. And once you're earning a 2% management fee on $1 billion fund, so you make $20 million on the 1st of January every year, what's your incentive to take any risk? And that comes back to one of the points on the first slide where I said there's an interesting stat here that the average hedge fund only lasts 4 years. There's a reason for that. And that's because they tend to get really rich off the management fee. Their performance goes down over time because they take less risk, there's no incentive, and then all their AUM leaves and the business goes out, or the fund goes out of business. So I think you have to have a differentiated business model. So in answer to your question about being a contrarian, I like to think we're contrarians in both respects. We're contrarians in the way that we have set up our fund with our fee structure. The management team are the second biggest investor in our fund, so we really do have skin in the game. And then the second way is with the investment philosophy. So I actually believe that investing is not a team sport. For me, investing is a solo pursuit. So, and I've come to that because that's what works right for my temperament. I don't have a team of 10 analysts working for me coming up to me with ideas. I have 2 people that work with me, and I get them to work on my ideas. They don't come up to me with ideas because I know what my own circle of competence is. So employing someone that comes to me with what they think are great ideas, they might sit way outside of my circle of competence. It's a complete waste of time. So I'm capable of delegating parts of the investment process to other members of my team. So it's a team-driven process, but ultimately I'm the managing partner. I'm the chief investment officer. Buy, sell, hold, that decision is mine. Idea sourcing, it's also mine. Other members of my team can come up with investment ideas, and they go in what we call the watch list. I actually don't see who puts those ideas in, so I'm not biased by who I thought might have a better idea than somebody else. And I'll look at them and I'll run them through the same filters as run every other investment idea through, but they don't get any priority. So I've set up my fund in the way that works well for me as an investor. Now, I do know other people that have teams of analysts and multiple portfolio managers for different strategies. There's lots and lots of different ways up the mountain. But coming back to the answer to the previous question, which is you need to find what works for you. And how do you convince people? Well, you've got to be right. I think that's key. So the first time you have a contrarian opinion, you're probably going to get a lot of pushback from your colleagues, especially within your investment fund here, or whether it's at the investment bank you go and work at next, or the fund you work at next. Typically speaking, most people don't like contrary opinions. But the only way to beat the market is to be contrarian. Otherwise, you're going to have the average returns the same as everybody else. You can't outperform. But you've got to be contrarian and right. That's the key thing. So I would say that you have to develop a track record of having contrarian investment ideas that actually ultimately end up being good returns. And an example would be if you come up with one and everyone disagrees with you and you don't do it, if it actually ends up being a right one, well, that would be a good one to bring up a year later when you've got another idea and you go, hey, I've got this second idea. The first one actually worked out really well. We didn't do it. Why don't we put a little bit of capital into this one? And you develop a track record that way of having insight that's different from everybody else. And that would be what I would suggest. Sure.
Yeah, I'm sure a lot of us here would like to understand a little bit more about when you went to China for 6 weeks for idea generation and for observation purposes. Just curious, like when it comes to, and perhaps you can tell us about the China trip as well, but just generally, what would your day-to-day, what would your information sources look like? Apart from perhaps a terminal or the big papers, the FT, Wall Street Journal, whatever you're reading. Would you consider physically going to a place and seeing something as constituting part of the information sourcing, and is that part of your edge? Which is it?
So I'd say that there's multiple avenues of idea generation. Buffett would famously said that he doesn't think anyone's got an edge on him, and he hasn't got an edge on anybody else because he goes, all I do is read the newspaper, which to a certain degree is true. A lot of our ideas come from the media. So one example was exactly the China idea. I was reading the FT, reading in Bloomberg, so many articles, so many bank research articles, basically China's uninvestable, Xi Jinping is cracking down, there's going to be a dearth of entrepreneurs, a dearth of good businesses there, everyone should pull your capital out, China's going to have negative returns for the next decade. And when you read something like that, I think you have to start being slightly contrarian and being like, can that be true? Can that really be true? That the second biggest economy in the world that's grown at between 5 and 10% per year is going to have a negative stock market performance for the next decade. There's going to be no great entrepreneurs. Is that true? And I guess that comes back to answering the previous question about being contrarian, which is another way of thinking about it is, what's the media's purpose? The media's purpose is for you to buy the FT or buy Bloomberg, a subscription. How do they do that? Attention-grabbing headlines. So when the stock market falls 2%, they'll say, market calamity, S&P's fallen 2%. And then obviously everybody clicks on the articles just to see how much it's fallen. And it turns out it's 2%. And you go, it's not even news. So I feel like a lot of the headlines, especially the negative ones, are hugely overemphasized. There's actually a lot of academic research on this because it tends towards human nature. We're very scared of negatives. Comes back to the point of the fact that we're much more willing to hold on to a loser and sell a winner. Human nature is, if you see something that looks incredibly risky, tend to stay away from it. And media headlines that play on human emotion, tend to be the most watched, which is why whenever you turn on the news, it's always something bad. It's very rarely you see anything good on the news. It's more attention grabbing. And so when it comes to our investment process, read all the news. I give you an example of how that works. So I read an article that basically said, slightly related to the China story, that basically said that everybody's going to drive an electric car in 30 years' time. And I just read that and I was like, can that be true? And if it is true, what does that actually mean? That everyone drives an electric car. So it basically means no combustion engines. We've all got cars with batteries. So it's like, okay, so how would it be possible to make money from that thesis? Well, we could look at all the OEMs. So we could look at the people that make these cars, Tesla, BYD. We could go a level lower than that. We could say, right, well, all of those cars are going to require some components that are the same. Tires. We could look at tire manufacturers, Michelin. We can see what's the valuation there. We could also look at battery manufacturers. Every single one of these cars is going to have a battery. Very few of these companies make the batteries in-house. So they're all going to have to buy it from somebody. Panasonic, who we touched on in the presentation, BYD, CATL, those are the two in China. So we can go and have a look at those. Or we could go a level below that. We could be like, well, all of these batteries, by what we look at today, are going to be solid state or lithium ion batteries. Where do they get the lithium from? Who mines the lithium? So I went all the way down the value chain and I actually ended up on the salt flats of Bolivia looking at lithium mining companies because they actually have the lowest lifting cost for lithium off the salt flats in the world. So that's an example of where you can read something and you can go massively down a rabbit hole to try and find an investment. And that's I do think that part of that is our edge. It's the ability to follow our curiosity in terms of where we think we're going to find incredible investments. Where in the value chain of everyone driving an electric car are we going to make money? So that's one example. A good example with China was the fact that when I went and visited, the only part of the stock market that had done well in April of 2023 were luxury goods companies. Everyone basically said China's uninvestable, but the Chinese luxury good industry is going to be really, really good this year. I just read that and I was like, how can that be possible? That China's economy is going to be doing really badly, but apparently the middle classes there are still going to all buy Louis Vuitton handbags. LVMH stock was up to roughly 25% by March of 2023. And I was there in February. And I basically went to the 6 major cities in China. And there's a really easy way of testing this theory. Why don't you just go to every LVMH store or every Tiffany store, which LVMH owns, in each of these cities and just see how many people are there buying goods? Because if you're going to buy a Louis Vuitton handbag, you tend not to do it online. You tend to do it in store. So I just went to all the big luxury shopping centers and they were all completely empty. So it's fairly obvious to me that all the headlines in the West we were reading about LVMH was going to have a great year. Chinese consumer was still going to be strong in the middle classes buying luxury goods. I couldn't find any evidence of that whatsoever. I reported that back to my team. And then lo and behold, the April results come out and LVMH stock falls 25% in a day because the Chinese consumer hadn't come back. And the only thing you needed to do to verify that all those media articles was go to China and have a look at a couple of luxury goods stores. And what it comes back to the point is about being a contrarian. You can't believe everything you read. You do have to do some investigation, which is why sometimes it is necessary to go and visit countries. Now, that's an extreme example. I'd say if you're investing in emerging markets, it's much more necessary to go and visit. But in developed markets, I think it's slightly less necessary. But that's an example. LVMH is a developed market business, technically based in Europe and France, but they make a lot of their revenue from the US and from China. So that had a substantial impact on their business. So there's lots and lots of different ways of having an idea generation. For me, for my fund, I do think we have an advantage by the fact that we can go to these places, meet the management teams of the businesses we want to invest in. But one of my favorite things to do is to meet management teams of the businesses that are in the same sector as the business that we think is the best, and find out who they think is the best business in the sector. It's quite an interesting one. So you might, there's 5 businesses in the sector. You go to, in this example, Shenzhen in China, you meet all 5. And you ask all 5 the same question. If you could work for anyone in this industry, who would you work for? And it's amazing how often they all choose the same company. And you might ask, well, why? And then you have a look at the financials, and that company will have stronger metrics in every respect. They're doing something different. And usually it might be an intangible. It might be something like the culture of the business, the way it's run, the entrepreneurial zeal of the management team. And those are things you can't always identify in the financial statements. You need to go have boots on the ground, meet the management teams and the competitors to really understand that. Now, it's not always the case, but I'd say for us, it's more than half the time. And that's one of the advantages I have as a fund manager over potentially yourselves in terms of being able to go. But we don't have any inside information. It's just the fact that we might do a lot more in-depth research than some other people will do by actually going and visiting and what I call putting boots on the ground. Thank you for the question. Sure.
Hi. So you said that you have to have perception and foresight, for the egg to develop into a bird. But the graph you showed, and specifically the one where it says all the hedge fund allocations, believe there was a metric there that said the emerging markets in, I think, South America was 0%. And me, myself, coming from Venezuela, I personally can't believe that, hedge funds aren't jumping at the opportunity to, have a crack at proper Latin America, because there is quite possibly the biggest untapped resource potential in the whole wide world under the Amazon rainforest. There's the amount of cobalt and lithium that is in Colombia and Venezuela is ridiculous. And as you said, the salt flats in Bolivia, it's one of the lowest ranking, for price. But it strikes me as so odd that hedge funds are so afraid of this while having, you did the research, this is the company that does the list, but why are they so afraid to, jump in right now as opposed to later when everyone's on the bandwagon?
Yeah, I think what you're pointing out there is just human nature. We love the warmth of the crowd. We don't like to be contrarian. You think about how do human beings exist in society? We exist in groups. We're social animals. We value the warmth of the herd. You are going to associate with people that you like because they have traits that you like. And that's true of all human beings. Very few of us have no friends and live totally alone. And this is what I believe the basic answer to your question, which is the fact that when someone shouts fire, everyone naturally runs away. And only one person needs to shout fire in a crowded cinema to see what will often happen. Everyone will stampede towards the door without taking a second to walk around and be like, but is there more than one exit? Because you'll naturally tend towards that one without seeing the exit at the back of the room. And that comes back to temperament. Because I think, to your example, I think Latin America is a hugely untapped area. We have one significant investment there that's one of our biggest portfolio positions. And I think it has a lot of things going for it. But what you'll see from the history of Latin American markets is the amount of volatility in those markets, the amount of people that have lost money over time, even in emerging markets in general. A lot of investors call emerging markets the permanently emerging story. They just continuously emerge, but they've never actually emerged because the volatility puts people off. So it's not the fact that the investment opportunity isn't there. Everyone knows that there's huge potential. But the point is if no one has seen anyone realize that potential, if no one's made huge money doing it, it's very often that people won't follow the crowd into that until they see that actually happen, which tends to be typical human nature. So coming back to what I talked about earlier about the S&P 500, when I was just talking about momentum-driven markets, I don't know, it's an interesting statistic, but or I think so. So last year, the S&P made 20%, right? Roughly, simple maths. What portion of investors that invested in the S&P tracking funds last year made 20%? Anyone just throw a guess, throw a number out. There's 100% of investors invested in the S&P 500 tracker. What percentage of them do you think made 20% last year?
0.
So it's not 0, but reasonable guess. Any other guesses? Just throw a number out.
40%.
40%. Yeah. So roughly half of the investors in the S&P 500 last year made less than 20%. And you might ask, how the hell is that possible? They're not even stock picking. They're just buying an index. But it's because they're doing exactly what you're highlighting there is they're following the crowd. Typically speaking, they only bought after an up day in the S&P 500. They saw it went up 4% yesterday. They go, now's the time to buy. And then they saw it go down a month later by 3%. They go, now's the time to sell. So they're always buying after it's gone up, and they're always selling after it's fallen. So the typical investor in the S&P 500 last year made less than half the return of the S&P. They made 10% or less, more than half the investors, because they're buying high and they're selling low. And that's that basic human instinct, basic human nature. By nature, we're not good at this. We're not. And that's why it comes to having a different temperament to be able to be successful in markets. Thank you for the question. Sure.
Well, you talk a lot about the temperament, and obviously you seem to have it, but how do you ensure that your investors don't run away from volatility? How do you ensure that their money stays with you through the thick and thin?
So it's very, very important that how we think about it, that our business has to be aligned with our investment strategy. So the gentleman here asked, sort of said it earlier when we were talking about our fund fee structure, and he mentioned that my fund is invitation only, which is true. So I meet all of our investors. I explain to them how we invest. And typically our investor base is self-selecting. So the people that have invested with us understand how we invest, and they tend to refer other people that they know have similar traits and would therefore be good investors for us. Because we do have business risk. If the portfolio falls by 50% and all of our investors go, oh, we want our money back, we've got a business problem. What we want is a selection of investors that go, oh no, Ardal, we fully know all of the 30 businesses that you own. We think that they'd be amazing value if they go 50% off. We'd like to buy more. Those are the kind of investors that we're looking for. And one of the ways I've explained is to self-select them. So you need to basically interview all of your investors. And that's why we call it a partnership, because I'm allowing you to invest in my fund. And you're also granting me the privilege of managing your capital on your behalf. It's a partnership. But we're only going to allow you into my fund if you understand how we invest and you have the right temperament. And we don't get it right all the time. But it tends to be, coming back to the question from before, we tend to associate with people that are like ourselves, that have traits in us that we like and admire. So if you're already an investor in my fund, it probably means you have the right temperament, you like long-term, you like concentration, you like value investing, you like the risk of investing in individual businesses and the returns that come with that. And therefore your friends that also invest tend to also do the same. So that's probably the best way of us fundraising, which is via word of mouth from existing investors. Thank you for the question. Okay, I'll wrap it up there. The lady at the back, what was your name, sorry?
Me?
Yes.
Oh, Charlotte.
Charlotte, I was going to give you a copy of the book. And it's one of the reasons why I love coming and talking to university students, because the questions that I get here are not at all what I get in investor presentations, whereas here I really feel like we get challenged. So thank you all so much for your time this evening, and thank you for joining. I like that question.